Hello, everybody, and welcome to the show today. So I'm really excited everybody could be here because with us today is really one of my own personal favorite lenders, or not lenders, but lending platforms that are out in this space that can get you access to a lot of capital in a lot of different ways in one location, which I'm really fond on. I think there's such a problem in the lending marketplace right now because there isn't more companies like this that are out there. So we're going to dive in and talk about a lot of cool things related to getting money for your business. So with us today is Priyanka Prakash. Now, Priyanka is a senior staff writer at Thundera, a marketplace for small business financial solutions. Now, at Thundera, Priyanka writes a variety of content assets and reports, particularly on the topic of small business finance. Now, previously managing editor at Fit Small Business, she's also a licensed attorney who serves as general counsel at a Y Combinator startup. Priyanka's work has been featured in Inc., CNBC, Forbes, and other top-tier publications. And when she isn't writing, she loves to explore New York City with her husband and her daughter. Priyanka, thanks for coming on today. I'm excited you could be here.
Yeah, I'm excited to be here, Ty, and thank you for the great introduction.
Well, let's get started right at the beginning because I almost messed it up, right? So I said Fundera as a lender, but the reality is you're not a lender. What you do is accumulate a lot of funding sources in one. So let's get that clarified because I think a lot of people still aren't exactly sure of how that works. So talk to us a little bit more about what you guys do over there.
Yeah, so that's right. So Fundera is basically a platform for small business financial solutions. One of those financial solutions is small business loans. That's about like 85% of our business right now is small business financing. And small business owners can visit our website, fundera.com, answer a few simple questions about their business, and we will match them up with the perfect financing product for them. We have over 30 different lenders that we partner with, and each is kind of well suited for a different type of business. So we look at things like your credit score, your time in business, and your revenue, and we match you up with the best one. And we've launched in 2014, so it's like our fifth year now, and over that time, we've helped about 35,000 businesses find financial solutions and secure over $1 billion in funding.
Wow, that's amazing.
Yeah.
From your perspective, what are some of the challenges that entrepreneurs are facing out there when they're trying to actually secure funds to grow their business?
Mm-hmm. Yeah, it's a good question. And I would say there are, a few different things. One is a lot of business owners just don't know where to start. It's almost a problem of having too many options, because there are a lot of different ways you can go to raise capital. You can try to raise equity by approaching investors. You can rely on your personal savings. You can approach family and friends, or you can get a business loan. Out of those options, personal savings and debt financing are often the most popular, just because raising money with investors is not realistic for most companies. That's an option if you're like thinking you're going to, you're a tech startup and maybe have a rapid growth that you've planned in the next year or two. That could be an option. But for most like not mom and pop businesses and small businesses, equity is an option. So either you can tap into your personal savings if you've fortunate enough to have saved money from a day job or from investments or what have you. And then if that does not describe your position, debt is often the only option. And it's often the best option because you're not giving up any ownership in your company. You can have 100% ownership of your company and run your business the way you want to, but you have the capital that you need to succeed. So that not knowing where to start, that's one of the big problems. The other thing is when you're a startup, even if you say like, yes, I am going to get a business loan, that's how I want to raise capital. It's often hard to make that happen because you don't have a record built up. Like there's nothing that you can show on paper for a banker to say like, I trust this business. Yes, you've raised, $100,000, you made $100,000 of profit last year. So I'm going to give you a loan and I trust that you'll be able to pay me back. Unfortunately, for a startup, that you can't really, it's hard to show that. So a lot of times you have trouble accessing funding. And the last thing I would say is poor personal credit. That's a big challenge. I think the personal credit score in the US is like somewhere in the high 600s, which is actually pretty good. But that means half of people are below that number, and so fall into like the poor credit category. And if you've had some financial problems in the past in your personal life, then that can affect your access to capital for your business later.
So one of the things, and that's a great rundown of a lot of the biggest problems that are out there with preventing or holding entrepreneurs back from getting the capital. Well, you touched on one really early, which is that there's so many different funding programs available that it's like information overload, right? So
Mhm.
how do people really know where to start? Is there a formula? Is there a way where they can kind of look at what their credit or their assets or what their strengths are and then figure out from there what kind of options the direction to even go to find the right option?
Yeah, I would say there are three sort of like most important factors when you're trying to figure out which funding option you should go with. And those three factors, which I'll talk a little bit more in detail, are personal credit score, the length of time that you've been in business, and your business's annual revenue or profit. So to take personal credit score as the starting point, as I kind of alluded to earlier, that's a number that you are probably already very familiar with, especially if you've bought a home in the past or tried to get a car loan. It's that three-digit number that ranges between 300 and 850, and anything above 670 or so is considered good credit. Now, if you're in the good credit bucket, that's great news because you have the greatest number of funding options available to you, and the best one is the most affordable one is probably going to be a bank. So, in those cases, I would recommend that the business owner go to their local bank and talk to their banker and see if the bank can give them a loan, because that's going to have the longest terms, the lowest interest rates, and the most manageable monthly payments. If you have lower personal credit score, you probably need to consider alternatives, and there are a lot, fortunately, now. After the economic crisis, a lot of banks stopped lending to small business owners, and so to make up that gap, a lot of alternative lenders entered the scene, and now you can go online and apply to companies, online lending companies, and they will sometimes lend money to you even if you don't have the best credit. So that's an option. And then there are things like, which are, financing, which is not at all credit based, like crowdfunding. And that's also an option if you have really bad credit, but you have an amazing product idea or service idea. You can check out like a crowdfunding portal and get members of the public to actually fund you. The second factor, which I mentioned before, was time in business. The best bucket to be in for time in business is if you have a business that has been around for a couple of years already. If you've already maybe you've bootstrapped the business with your own finances for a couple of years, and now you've run up against a financing hurdle and you need more money to get to the next level. Well, if you can show a positive financial history for the last couple of years, a bank is probably pretty likely to lend you money. But if you're newer than that, if you've only been around, say, for a few months or less than a year, it's harder to get funding with a bank. And in that case, we recommend going with an online alternative lender. And the last factor is annual revenue and profit. So for the best lenders, and I'm talking bank lenders and SBA loans, which are government guaranteed business loans, you ideally would have a profitable business. That's just not where a lot of small business owners are when they need capital. They're, pre-revenue or pre-profit. And in that case, again, you need to figure out alternative solutions like crowdfunding. Maybe use business credit cards. That's a great option. You can actually get approved for a business credit card without having a business that's already up and running. Even if you're just in the planning stages, you can often qualify for a business credit card, and those have some pretty high credit limits and will allow you to sort of get started and maybe launch your prototype or launch your product. So those are some things to consider. And, honestly, I don't want to sound like a salesperson, but if you don't want to do a lot of that thought process and analysis yourself, that's where a portal like Thundera helps, because your loan specialist will actually help you analyze all those factors and say, like, okay, based on where you are, this is like the best option A for you, this is option B, and so forth.
Yeah, and it's invaluable because, like you said, there's so many different options, so many different qualification factors with each option that it's typical that somebody's just not going to know exactly what to do. When
Yeah.
somebody is out there in the space and looking around, they're checking stuff out, what's some of the stuff that you've seen that they really need to pay attention to and be focused on when they're trying to get money from these alternative lenders versus banks?
Mm-hmm. So the good thing about alternative lenders is, like, the application process is actually significantly easier and significantly less time consuming than you'd go to a bank. So if you go to a bank and apply for a business loan, you have to be prepared for like hours worth of gathering paperwork. We're talking about several years worth of business and personal tax returns, um, business debt schedule, collateral schedule. The list goes on and on. If you're going to an alternative lender, most of them are only going to ask you for the past few months of business bank statements, and maybe depending on kind of what credit profile they work with, you might have to show a year or two of personal or business tax returns. Other than that, they will pull your credit report, obviously, and check your credit score. That's really all you have to worry about from like a paperwork standpoint. They really have taken a lot of the paperwork off the small business owner's plate and kind of tried to make it easier to get financing. On the flip side, because it's easier, as you might expect, these alternative lenders are more expensive than banks. So you want to be careful that you're not, especially if you're just starting out in business, that you're not overstretching yourself and committing yourself to a loan that you might not necessarily be able to pay back. So it's definitely a trade-off.
So we talked about SBA loans, and you talked a little bit about that, the qualification. If you have the cash flow verifiable and the profits and the credit and those type of things, that's a good fit. If not, these alternative lenders is probably the better place to go. When you see people getting denied for loans, and you already maybe hit on this when you talked about some of the things that people need to do to get approved, but why do you see so many people why do you see people get denied? What are some of the biggest reasons that you see that loans get denied that the business owner could correct instantly or in time and then turn around and have a better chance of getting approved?
Yeah. So the number one factor is credit, because sometimes people assume, like, this is a good example. Like, somebody might have a successful business. They might be generating pretty good revenue. They might even be close to profit or already profitable, but due to like some personal circumstances in the past, like maybe they had to file a personal bankruptcy, or like their home was foreclosed or something, their personal credit score might have taken a hit, and so they get denied for that reason. So fortunately, the bad news is you get rejected, and so you might not be able to get capital right away. But the good news is that that's something that's actually pretty, that there's a clear way to fix it. So we recommend, like, small business owners take a good look at their credit report, so you can get free access to your credit report once a year from each of the three main consumer credit bureaus, Equifax, Experian, and TransUnion. And just like look what's on there. If there are any errors, that's a big part of it. Something like 20% of credit reports have errors on them. If you find an error on your credit report, follow the bureau's dispute process for how to fix it, and you'll oftentimes see like an immediate jump in your credit score within the next cycle, and that might put you into that credit bucket where you're able to qualify for that loan. If you don't have any errors in your credit report and it's just like personal financial circumstances that will take time to fix, but there are ways to fix it, like just making sure, maybe you get a personal credit card and you diligently pay it back every month on time, and you borrow as less as possible and pay back as soon as possible. So that's like the biggest hurdle, is really the personal credit score, but it's also one of the easiest things to fix. Things like, if you don't have a revenue, don't have profit, that's harder to fix because that's like kind of core to your business. So if that's your position where you're struggling to make a revenue, I would say, look back at your business plan. You should always have a really strong business plan going into starting a business. And in that business plan, you should cover everything from, who's in your target market, like how are you going to stand out from competitors, what's going to be your marketing strategy, what are some realistic financial projections. And a lot of times if you're not making revenue, you can find the answers to why in some analysis that you put into your business plan.
What do you think about, and this is a problem that I see a lot of people come in with, is that they don't really know how much they need. And they never really broken down what they need the money for, right? You're nodding your head, so guys must deal with the same thing over there. What
Yeah.
do you do there? What would you wish that somebody would come in, already have figured out, here's what I need, here's what I need it for. What's your advice to kind of get that done before you go out starting to look for capital?
That is a great question. And yes, and it's a challenge for many businesses because you want to borrow the right amount of money. You don't want to be in a position where you don't have enough capital to scale, but you also don't want to waste precious cash flow on paying back a loan that's too large. So one rule of thumb that we use for a business that's already generating revenue is most lenders won't lend more than 10 to 30% of a business's annual revenue. You can kind of take that as a rule of thumb. If you're not generating revenue already, it's a more subjective analysis that's based on your personal credit score, and the lender might also look at if you have any other personal loans that you're paying back, because ultimately what every lender cares about is that you have enough cash flow to pay back the loan. And so if 50% of your business income is going, or if you have a day job, 50% of your personal income is going to pay back like your student loan, then you're probably not going to get approved for a very large business loan. And the term that a lot of lenders use is called debt service coverage ratio, or DSCR, which is basically takes your net income both from business and personal sources and divides it by your total debt payments, both from your personal loans and business loans. And when you do that analysis, the resulting number should be higher than 1, meaning that your income is at least greater than what's going out to pay back loans. So that's kind of, if you really want to be really prepared, like before going out and applying for funding, make that analysis and take stock of what kind of expenses and other loans that you have to pay back. I would say another thing is, when in doubt, take a smaller business loan and balance it out with a business line of credit. So the difference between a loan and a line of credit is with a line of credit, it's kind of like a credit card. You get a credit limit, but you're only paying interest on the money that you draw. So if I have a $100,000 line of credit, I could buy I could buy or charge business expenses to that line of credit up to $100,000, but I don't have to use all of it. I could just use it for buying something that's $10,000 and save the $90,000 for a rainy day. And a good example of where this became important was a few months ago when the government shut down. It affected something like 50% of businesses, and including some of the businesses that came to us looking for funding. And what we found was that businesses that had a line of credit already were in a much better shape because they could use that as like an emergency source of financing. So I would say, kind of, I guess if you need to underestimate what you need to take in a loan and take the rest out in a line of credit. And then the other thing I would point out is that when you're asking for funding, you should always make sure that you have a positive ROI and do that calculation for yourself. So for example, if you need to borrow money to hire an employee, that often has a positive ROI, because I might borrow $100,000 to cover an engineer's salary for 1 year. But if that engineer is going to add value to my company that equals $1 million, that's a positive ROI. And so it makes sense to take that loan.
So we've talked about a lot of different kind of loans, credit lines, etc. What if somebody does have multiple they qualify for? Like, what if they have the good credit and they have these things and they're able to qualify for multiple different types of financing? How does somebody really choose the right type of loan that works for them? What factors should they look at that kind of make it a better loan versus another?
I would say you should look at what you need the loan for and how long you need to pay back the loan. So for example, if you just need money to like pay for the next few months of inventory, it does not really make sense to take out a 10-year bank loan, because you want to buy that inventory, you're probably going to sell some products, and then as a result, you'll get the revenue back that you'll use to pay back that financing. And all of this will probably happen in the span of a few months or a year. In that case, even if you have amazing credit and you'd qualify for the bank loan, it probably doesn't make sense to get it. You should probably go for either a line of credit or like a short-term, under 1 year term loan. On the other hand, if you're making big investments in your business, like you want to build a new part of your retail shop, or you just want money for general business expansion and you have a really aggressive growth plan, then that is something that maybe you do need to take a 5-year loan for or a 10-year loan for, because those kinds of things are just drawn out a lot longer, and you might not see the ROI happen for a longer time. So I would say the two things are why do you need the money, and how long do you need to hold it on for. And also there are some things like if you need to buy a piece of equipment, well, there's a type of loan exactly for that called equipment financing, which is oftentimes very affordable and cost effective. It makes the most sense.
Yeah, and I like that, how, look, if you can qualify for that specific funding for what you're looking for, inventory, equipment, or whatever, then try to look at that kind of particular financing. What about rates and cost, right? Everybody cares about what they pay, right? Interest rate and et cetera. So, but a lot of people don't realize like what affects those things. So
Yeah.
how can somebody get the best terms? What kind of things are directly affecting the term that they actually get on that loan or credit line?
Well, the same factors actually that I mentioned earlier for eligibility also impact cost. So you're probably sick of hearing this now, but it's the time in business, the annual revenue and credit score really that go into affecting your costs. So if you have great credit, a revenue positive business, and you've been around for like 10 years, that's like a lender's best dream. So they're going to give you the best rate. On the other hand, if you're a startup or you're struggling credit wise, you're going to have to pay a lot more as a result, at least when you first start out. If you get a loan that's really expensive, but you're able to show that you actually are paying it back on time and you've made good progress, in the future you can graduate to a more affordable loan. The other thing that business owners should know about cost is not all lenders quote cost in the same way. So there's two main ways actually. There's interest rate, which you're probably most familiar with. So that like if you have a home loan also, you'll probably say, okay, my mortgage has a 4% or 5% interest rate. And that's just like a percentage of your kind of total loan balance, and then you're paying that back in interest. A lot of alternative lenders use what is called as a factor rate. So they'll say, this loan has a 1.1 factor rate, which means, and I'm terrible at math, but I think that would mean like if you have $100,000 loan, you multiply that of 100,000 by 1.1, so you'd end up paying like 110,000 back in total. to the lender. So you should just kind of understand how that works. And then you should also make sure you understand every single fee that you're being charged by the lender. That could be packaging fees, guarantee fees, and loan processing fees, origination fees. They come in many names, but all of those fees are going to affect your APR, or your annual percentage rate. And that's what it ultimately comes down to. You should ask the lender for your APR, because that is what will allow you to compare different loan products in an apples to apples way. But at the same time, you should know that APR and cost isn't everything. If you need if you need the money just to buy inventory, going to that previous example, it's probably worth it to buy the high APR loan but pay it off in 6 months than the low APR 10-year bank loan, because the total amount that you'll pay in interest over the life of the loan is going to be a lot more with the bank.
Yeah, that's awesome. So I love how you broke that down. You
Mm-hmm.
mentioned a lot about credit score. Is there really financing somebody can get out there without a credit check for the business? And I know crowdfunding, you touched on that, and credit doesn't really matter there. But is there financing where the credit score doesn't really matter, or you can even get approved regardless of a credit check?
There are a few options like that, and they're pretty limited. Equipment financing is one area where credit does not really matter. The exceptions are some lenders won't work with like a current bankruptcy, but even if you have a previous bankruptcy or a previous foreclosure, most equipment lenders don't mind, because the equipment is collateralizing the loan. And so if you end up defaulting on the loan and can't pay it back, although it is a pain for the lender, they can basically just repossess the equipment and sell that off and make up most of the cost. So that's one kind of non-credit check, or where credit is not as important. The other, another product like that is called invoice financing. That is important. That can be actually a good funding tool for B2B businesses. So for example, if you're an accountant and you provide accounting services to other businesses, and you invoice a business client for $1,000 for accounting help that you did for them for 1 month. And then let's say you give them 60 days to pay back that $1,000, but the client, kind of dragging their heels, they're really going to wait till like that 60th day, but you need the money right away. So you can use something called invoice financing, where the invoice financing company will actually front you that $1,000. They'll give it to you right away, subtracting a small fee. And then when the customer pays you back, you then pay back the invoice financing company. And in that case also, since the invoice is kind of proof that you're going to receive payment at some point, the company won't care about credit as much.
Now, on the opposite side, what if you do have good credit and you're just starting a business? Are there options there?
Yeah, if you have good credit, that's actually you're in a good position. It's harder because your business is new, but there are things like SBA microloans. So that's a program that the government does in partnership with like nonprofit intermediaries around the country, and credit is a really important part of that. If you have good credit, you can get a microloan up to $50,000 at a decent interest rate. It's going to be a little bit higher than a traditional bank loan, but much, much lower than what you'd get with an alternative lender. And you also are sometimes able to get like small, unsecured lines of credit at your bank if you have really good credit, particularly if you have a good history with that bank. Like maybe you have like your home loan through them and you made really good payments on that. As a result of that relationship, the bank might also, as a result of that relationship and your good credit, I should say, the bank might also be willing to like extend you a line of credit.
Great insight today. We've touched on so many things, and I like how you're talking about, exactly what it takes to qualify, things to do to improve your qualification. If you get denied, what to work on fixing. Let's talk a little bit more about Fundera. And I don't usually do this in podcasts, but I'm just such a fan of what you guys do because I think that you're out there solving a really, really, really big problem that I'm really passionate about solving as well. So like when I find companies out there that have that synergy, I just get stoked. So what do you see as the problem that you guys are mainly trying to solve?
I would say it's this thing that we started out with, which is the overwhelming feeling of not knowing where to go for capital. And I think the reason that happens is small business owners are a very passionate group of people, and they're great at what they do, whether that's being an accountant or running a bakery or running a lawyer's office or whatever it may be. Business owners are really, really good at what they do, but they might not be financing whizzes, so they don't know where to go for this capital, and that's where we want to provide a friendly, accessible way to get the right advice and get into the right financing product so that you can just like grow your business and do what you love.
That's awesome. I
Yeah.
love it. And like I said, I'm such a big fan because I see the same thing. What's happened was with Dodd-Frank and all that stuff in 2008, the banks tightened up, alternative lenders flooded the space. Now there's so much capital available. Nobody knows what works. Nobody knows if they can get it, what they can't get, where to go to look. It's just crazy. And then these lenders offer one product, two products. They go there, they don't fit them because they don't have credit, but they've got revenue. And then they think they give up. They think they can't get financing. But the reality is if they would go to a platform like Fundera, they would find out that, yeah, you don't have those strengths, but you have these strengths, and these strengths open up all these other funding options. And I just think it's so important to have access to all these funding sources in one place because when
Yeah.
you do so, you can get somebody more money. And it seems like you can get somebody money when they typically wouldn't get money from these other sources that only do one or two types of products.
Yeah, like we get messages from customers all the time saying like, I went to my bank and they turned me down, but thank you so much, Fundera, for getting me the capital I needed. So kind of like you hit on it, this portal saves time. It allows you to compare different options and get the best rates. And each person who goes through our process gets a personalized help for the loan specialist. So we give you a lot of good guidance there. And we realize that funding is not a one-time thing. You're going to probably need funding in the future as your business continues to grow. And so we want to be that go-to place where you can come back again and again.
That's awesome. Anything have left out, anything I should have asked that maybe I've forgotten to ask that you feel is important?
I think you covered it. I think you covered most everything. I would say it's kind of something I said before a little bit, which was if you're just starting a new business, I think it's just really important to come up with a written plan because that way you can see what you're getting into, how much money you might need in the future, and then based on that kind of determine which course you want to take for funding and then get help with a kind of customized solution like Fundera, which will help you help you get the capital that you need to grow and take your business to the next level.
It's awesome. Priyanka, thanks for coming on with us today. It's been amazing.
Thank you so much, Ty, for having me on.
So everybody, make sure that you check out Fundera.com. Look, we deal with 1,000+ lending sources. And I have to tell you that they're here because they are one of my personal favorites. I just think it's brilliant what they do. They filtered through all these different lending sources to find the best in each category. And then what they've done is put together this arsenal of funding sources that want to give you money, even when you're in these weird situations where you typically wouldn't get it at your bank. And what I like best is instead of going to a lender to apply and figure it out, you've got one marketplace. I think it's safe to say one
Marketplace, yeah.
marketplace, one platform where you can go to and access, boom, all of them in one shot. It gives you the best chance of getting the most money. It gives you the best chance of being able to get approved when you typically wouldn't get approved. So check it out. Their website's fantastic. There's so much great information, and you have a real chance of getting approved when you typically wouldn't get other kind of financing. So make sure you visit Fundera.com. That's Fundera.com to learn more and to get approved. And I will make sure that that link is on the show resources page. So thanks everybody for tuning in. Make sure you visit Fundera.com. Thanks everybody.